A trade war doesn't begin with tanks. It begins with something small, something ordinary, something so routine you barely notice it missing until it's gone. Imagine pulling into a drive-thru on a random Tuesday night. Long day, low patience. You order your usual combo. The speaker crackles back. "We're out of fries." That sounds trivial. Annoying, maybe, but trivial. Except this time, it isn't. Because what just unfolded between Donald Trump and Canada over potatoes may have triggered something far larger than a fast food inconvenience. It may have exposed how fragile the American consumer economy really is. Here's what just happened. In a surprise move, Donald Trump publicly demanded new trade concessions from Canada, targeting agricultural exports, specifically processed potato products. He accused Canadian suppliers of unfair pricing practices and threatened severe retaliatory tariffs if Ottawa refused to renegotiate supply terms. On the surface, it sounded almost absurd, a superpower picking a fight over potatoes. But here's where it gets dangerous. The U.S. fast food industry doesn't operate on symbolism. It operates on logistics, precision, timing, margins measured in cents, and a significant percentage of processed frozen potato products, the kind optimized for fries and hash browns, flows south from Canadian provinces like Prince Edward Island, Manitoba, and Alberta every single day. This wasn't about vegetables, it was about leverage. Trump's demand signaled something much bigger, a willingness to weaponize cross-border supply chains for political positioning. The message was simple: comply or face tariffs. The assumption? Canada would fold quickly to protect export revenue. That assumption may have misread the math, and this is where the math turns brutal. The United States consumes an extraordinary volume of frozen potato products annually. Billions of dollars in trade move across that border. Canada is one of the world's largest exporters of processed fries, with a heavy concentration of shipments destined for U.S. distributors. These are not interchangeable commodities. Processing potatoes are grown to precise specifications: high starch content, specific moisture levels, industrial contracts tied to specialized freezing facilities built over decades. American farmers in Idaho and Washington produce heavily, but scaling up instantly isn't possible. Crops take seasons. Infrastructure takes years. Supply chains aren't light switches, they're pipelines. And when political rhetoric touches those pipelines, uncertainty spreads fast. Canada's response was not loud, it was procedural. Rather than retaliate with counter tariffs, Canadian authorities announced a comprehensive review of outbound agricultural compliance procedures. Inspection timelines tightened. Documentation reviews expanded. Shipments slowed under enhanced safety protocols. Legally defensible. Technically routine. Operationally disruptive. Trucks began waiting longer at crossings. Processing plants recalibrated schedules. Distributors faced delays measured not in weeks, but in hours that mattered. Fast food logistics are built on just-in-time systems. Inventory buffers are thin, storage is expensive. When timing slips, downstream pressure multiplies. No official blockade was declared, but velocity decreased. And in modern supply chains, speed is power. Wall Street noticed immediately. Shares of major restaurant conglomerates saw volatility spike as analysts modeled potential margin compression. Why? Because the highest margin item in many combo meals isn't the burger. It's the fries. Low input cost. High markup. Volume driver. If supply becomes unstable, wholesale prices adjust. If wholesale prices adjust, franchise operators absorb or pass costs. If they pass costs, consumers feel it. Inflation doesn't need to be broad to be political. It only needs to be visible. Corporate calls reportedly intensified. Industry groups sought clarity. Procurement departments explored alternatives. Freight companies revised risk premiums. Here's what just happened beneath the headlines. Uncertainty entered a highly integrated North American food system, and uncertainty is expensive. The political pressure began to build. Business leaders don't respond to rhetoric, they respond to balance sheets. When margin forecasts narrow, lobbying accelerates. The White House faces two pressures simultaneously, demonstrating toughness externally and preventing economic backlash internally. That's where ego collides with economics. Trade disputes with distant rivals follow different rules. Supply chains are longer. Substitution is possible. Domestic audiences are less directly exposed, but disputes with immediate neighbors are different. The US and Canada share one of the most integrated trade relationships in the world under frameworks like USMCA. Energy flows south, agricultural goods move north, manufacturing inputs cross borders multiple times before final assembly. When friction appears at that scale, it doesn't remain localized. It multiplies. And this is the part nobody saw coming. This isn't just about potatoes. Canada supplies crude oil to U.S. refineries, lumber to American home builders, critical minerals for manufacturing, uranium for nuclear facilities. When one supply chain becomes politicized, markets begin questioning others. Investors ask, could this spread? Could energy become the next leverage point? Could seasonal electricity flows tighten during peak demand? Could manufacturing inputs face similar procedural slowdowns? Risk perception shifts quickly, and markets reprice risk faster than politicians adjust messaging. Zoom out. This moment reflects a larger tension in global trade. The use of tariffs as negotiating tools versus the quiet application of regulatory power. Public confrontation versus procedural enforcement. Leadership styles matter here. One approach relies on visible pressure, announcements, demands, deadlines. The other relies on structural positioning, understanding choke points, trade law, and logistics timing. Short-term optics versus long-term leverage. Neither side wants escalation, but both must manage domestic audiences. And here's where it gets unpredictable. Because supply chains don't operate on political calendars. They operate on contracts, harvest cycles, and shipping schedules. If uncertainty persists, procurement teams diversify. Alternative suppliers in Europe, Latin America, or Asia receive exploratory contracts. Capital investments redirect slowly, then permanently. Trade relationships built over decades can recalibrate quietly, and once recalibrated, they rarely revert completely. So where does this go from here? Three paths are emerging. Scenario A is the quiet de-escalation. Behind closed doors, negotiators adjust language. Tariff threats soften. Inspection speeds normalize. Both governments declare victory in carefully crafted statements. Markets stabilize. Supply resumes with minor pricing adjustments. The public narrative fades. Scenario B is escalation. Rhetoric intensifies. Additional tariffs expand beyond agriculture. Canada responds proportionally under trade agreement mechanisms. Energy or industrial inputs enter the conversation. Markets widen volatility. Consumer prices tick upward. Political blame games accelerate. Confidence erodes. Scenario C is the structural shift. Even without dramatic escalation, corporate America begins hedging permanently. Contracts diversify. Investment flows reroute. Canada deepens trade ties with Europe and Asia. The United States gradually loses preferential cost advantages in specific sectors. No headline explosion. Just a slow, permanent realignment. History rarely announces itself loudly. Sometimes it appears as a delayed shipment, a price increase, a contract not renewed. This situation is less about potatoes and more about precedent. Can modern economies weaponize deeply integrated supply chains without destabilizing themselves? Can political leverage coexist with logistical interdependence? And who absorbs the cost when rhetoric meets reality? The answer won't be delivered in a speech. It will appear in quarterly earnings, commodity charts, and consumer receipts. The next 72 hours will reveal whether this becomes a footnote or a fault line. Because once markets sense structural fragility, they don't wait for clarity. They price in risk, and risk, once priced, reshapes behavior. We are watching a test of North America's economic architecture in real time. Is this strategic negotiation, or the first crack in a system built on cross-border trust? Drop your take below. Do you think this de-escalates quietly, spirals into retaliation, or permanently reshapes US-Canada trade. Subscribe now if you want the next update before the headlines catch up. History doesn't pause, and neither do markets.